Sunil Singhania now joins us. So let me welcome Sunil Singhania on a new edition and a new show of Markets and More, a show in which we engage into a long format dialogue with Sunil Singhania to understand his ideas, his thoughts, some contra buying opportunity, and what exactly he has identified in terms of a trend or a large trend where both economy, earnings, consumerism and also habits are likely to move. Sunil, fantastic to have you back on Markets and More. Thank you for joining us. Sunil, we are less than 3% away from an all-time high on the Nifty. The ring of all-time high is an extraordinary ring for investors. But considering that what we are staring at is the following: political uncertainty in US, mild recovery in economy, and the second wave of coronavirus in Europe. Are you pleasantly surprised, delighted, and even shocked with the strength of underlying market?
So, Nikunj, you put it very nicely, but as a perennial optimistic and a perennial bull on Indian equity markets, I think anything which is pleasant is always welcome. Having said that, I think as far as the US elections are concerned, I think the positioning before the elections was so cautious that at least we were very convinced that irrespective of the verdict, the market will have at least a near-term bump up. And I think that is what is happening. As you rightly mentioned that, the things are still not clear. Obviously, Mr. Biden has, right now, a bigger probability of becoming the president. But, if 10 days back or a week back, if someone would have told us that this election is going to be so close, we would all have been very, very negative on the market. I think the same thing happened in 2016. No one expected Mr. Trump to win. There was a shock in the market, and then, we had the bull run of our lifetime. So I think the positioning this time was so cautious that it was very obvious that the market, at least in the near term, would have a big run up, and which has already happened. I think post that, I would say that we are in a position where we'll consolidate. On the economy front, yes, there has been a mild recovery, but it is much better than what the most optimistic, analyst or economist would have expected even 2-3 months back. We have GST numbers come up back to normal. We have PMI, which is like a multi-year high. Car sales, two-wheeler sales, multi-year highs. So it's been a very strong recovery. And more than that, I think the earnings season this time has been rocking. Whatever results we have got so far, across the board, there has been massive outperformance. And it's not one or two sectors like in June, which were performing this time. It is across the board. So you have cement, you have steel, you have banking, you have pharma, IT. I think across the board, you have had optimism. The last point which you mentioned is obviously a worrying factor. I think the number of COVID cases every day globally are moving up. It's almost 500,000 cases a day. But the good thing is that mortality rate has not gone up. And, it's now become sort of a known thing that we have to live with it. We have to take care. We have to be, a lot more precautionary. But, ultimately, if we do that, it will come and go. It's not going to be the end of the world. And in India in particular, the cases have been going down. The economies have been opening up. Even in our home state of Maharashtra, I think almost everything is opened up now. So there is optimism. And we do hope that in the next 3-4 months, there will be something which is decisive in terms of a vaccine which is going to be unveiled. So things right now seems to be in a much more optimistic state of affairs than they were, say, a couple of months back.
Okay, so I'll pick up from the optimistic part, which is that earnings are good. For the first time, it's a relief to see that we are in for an earnings upgrade rather than a downgrade. But how does one figure out, Sunil, that this is not a function of base or pent-up demand? We got the following message from Maruti. We are feeling happy, but we are not sure what will happen to demand post-December. Can we expect the demand to stay permanent, and is the earnings trajectory now likely to improve?
So one is the same company had predicted a doomsday in April and May, So I think everyone is living by the month. No one is sure about whether this demand is going to sustain or not. But there are a few anecdotal, I would say, evidences which make us much more positive. One is the number of job losses which people were expecting have been much less than what they were expecting. So the actual number has been much less. Yes, there have been job losses, but they have been much less. I think the biggest driver is the reduction in interest rates across the board. So, whether it is EMI for cars or EMI for houses, I think there's been a massive, massive fall. And particularly in the case of residential sales, if you actually see, EMIs are down from like 1100 or 1100 per lakh to as low as 750 rupees a lakh. And that is driving a lot of demand. Whether this continues, that we have to see. But at least 50-60% of the Indian economy, which is non-urban, has seen no impact of COVID. In fact, because of the excellent monsoons over the last 2 years, agricultural produce has been good. Agricultural prices in India and globally have been pretty robust. And rural income has been sort of unaffected, during this whole lockdown. Hopefully, as the urban centers also open up, there will be an added wave of, I would say, consumption demand. Whether it lasts beyond 3-6 months, that is something which we have to see. But at this point of time, it does seem to be a lasting kind of an environment.
Okay. Before we get into specifics, Sunil, one question on the market positioning. Good news and good prices, they don't come together. We both know that. In March and April, news was not good, prices were good. But right now, mood is better, optimism is back, you're sounding bullish, and some of your peers are also optimistic. So our price is also good, because for markets to keep on going higher, you need some support, you need some surprise. It's like a car which needs fuel to stay on road.
No, you are right. I think, obviously when you see the prices which are prevailing in March and April and you see the prices now, you wished you had leveraged yourself and bought much more than what you had in April. But that's always the case. In hindsight, things are so much more clearer and so much, easier. Having said that, I think, yes, there are stocks which are doing well and prices are also reflecting that. But there is more than enough, I would say, sectors and stocks where there is still a little bit of apprehension. I would say banking, good financials are a segment which has done well last 10-15 days. In fact, they have been one of the reasons why the Nifty is where it is today, despite one of the largest index heavyweights having lost 15-20% over the last 15-20 days. But, there is a little bit of apprehension and there are opportunities. I would say the broader market still has opportunity. And the most important thing, Nikunj, is that the alternatives to investments, which are like fixed income, there you are making 3-4%. So I think if your return expectations, you tone down to maybe 9-10% per annum from equity markets, you would still find more than enough opportunities to invest and to make those kind of returns.
Come up on your screen that how liquid scheme returns have collapsed and how an MNC bank fixed deposit rates is less than 4%. Just think about it, guys. Less than 4% is unheard of in your fixed deposits. If you're really putting your money in fixed deposits and not putting into productive assets like equities, the challenge is that when inflation will come back, you would really be underperforming your financial assets. I'm saying something very basic. Sunil, if I look at the portfolio positioning of the funds which you manage and with information which is available in the public domain, you got a lot of IT in the portfolio now, whether it's HCL Tech, Root Mobile, or even Mastech. Why is that?
So one is, I think, the world is changing and the way we are working, the way we are studying, the way we are consuming, the way we are entertaining ourselves has completely changed over the last 6 months in particular, but it's a trend. And I think it is going to continue. Every company has to have a digital kind of a framework, glued on as far as their IT is concerned. You need to work from home, you need to have good systems. And I think that would lead to more and more, demand for IT generally. As far as Indian IT services is concerned, I think there was a lot of question mark in the run-up to the US elections. You had H-1B visas, issues and so on and so forth. And despite that, the sector continued to grow in the lockdown. In fact, the margins went up because, it became more efficient. Work from home has led to margins expanding. On the other hand, the whole advent of, doing everything in a digital format has opened up avenues for new businesses. And unfortunately, in India, a lot of these new businesses tend to be in the private domain. There are a handful of companies which make it to the public markets. And our view is that one, these businesses are going to grow fast. They have a long way to go because they are very nascent. And third is there are hardly any such businesses available for investment on the listed space. So our view is that good quality companies, they are cash flow generating companies, and I think there is a lot of visibility as far as their earnings are concerned. So we would rate them much higher than the so-called consumption stocks where the growth is limited. The P multiples are like 70, 80 times. And the cash flows are similar to these companies. And I think that is what we have been playing for. And so far, touch wood, it's worked very well for us.
Look at that graph. In 2014, State Bank of India, less than 1 year, the fixed deposit rates were 8.75%, which have come down to 5%. Now, 9 coming to 5 is not a 4% drop. It's almost a 40% drop in your net projected returns if you're putting money in fixed deposits. Just think about it again, and I'm not even accounting for inflation here. Sunil, in the first episode of Markets and More, we spoke about a trend which now has, we spoke about a aspect which has now become a trend, and that was UPI payment. UPI payment has only increased, and the amount of digital payment transactions which we are doing now is increasing at an insatiable pace. Is that the theme which you are playing in your portfolio without getting into stocks here, but the fact that you have Route Mobile looks like you're betting on this entire digitalization of payments?
So Nikunj, I remember that earlier, you had to carry a wallet with some notes in it. I don't even remember whether I have a wallet in my pocket nowadays because, everything you can do is through your phone and through digital mode. And if you go to some of the other countries like China, no one even accepts hard currency. And I think this is going to become the norm even in India. With digitization, with UPI and such very efficient payment mechanism becoming the norm of the day, you need security, you need a little bit of extra layers of authentication. And the companies which are involved in this, whether through the OTP route or through the WhatsApp authentication routes, are going to benefit a lot. And India is a large country. You see the number of transactions which they are growing. So I would not say only one company, but any company which will benefit out of either the payment gateway space, the authentication space, even the digitization space. I would say it is the biggest fintech opportunity which is there. And it's not only in India, it's catching up globally. In fact, the UPI has done phenomenally well in India, and it is now being exported to other countries. India has been at the forefront of adopting the best technologies and the cheapest at the cheapest cost. And I think more and more countries will embrace that. So I think the opportunity for Indian companies in this space is not only in India, but it's a global opportunity.
But Sunil, in your own words, you've always said that, look, I like to buy things which are cheap. Buy companies which are growing at 15%, which are available at a P of less than 15% and have return ratios of 15%. 15, 15, 15, if my memory serves me right. But some of your recent investments, do they qualify that cut?
At the time of investment, they qualified. And frankly, I will say that the profit growth in some of the companies which you are tacitly referring to will surprise. We just have to see. So I think we continue to be very confident about our investment philosophy. Nikunj, I would just add one thing here. Yes, we are a little bit value-oriented investors. But if the growth rates are 40, 50%, you are okay giving a slightly higher valuation. We are averse to investing in companies which trade at ATP and where the growth rates are 5-10%. That does not justify. And I think that is one clarification which I'd like to make here. So if the companies are growing at 40-50%, I think it's a matter of maybe a couple of years, you will start to see their P ratios much lower than what they appear to be right now.
You're not sticking to the usual names in your portfolio. You are taking very interesting, outsized, but a very differentiated approach to the strategy, to your portfolio strategy. Why is that?
So, there are two ways of investing. One is you want nifty returns. And I would say that as portfolio managers, what can we add there? An investor is better off investing in an ETF and saving on 2% fees. And that goes straight to the bottom line because, in a 9-10% expected return, 2% is like 20% of your returns. The other way is to take bets which are, in-house researched, where we believe that there can be alpha which can be made post fees. And I think that is what we basically bank on. And the other thing is, you have to bet where your conviction is, where you have worked very hard. You might go right, you might go wrong. As long as you go more right than wrong, I think we are home. And as I said, it's worked very well for me in my life last 20-25 years. And it's worked phenomenally well over the last 2 years since I set up Abakkus. And I think that is what we believe in. So, this has been a very dynamic kind of an investment phase, Nikunj. You had a phase where you were like lost completely. June was a washout for almost the entire economy for most companies. September, we started getting back. Nikunj, one thing we have to remember, even from an equity market perspective, generally, is that we are now going to head to a phase where the base is going to be very weak. So, leave alone December, because December last year was also pretty good. And this year also should be pretty decent because Diwali is right now in the middle of the quarter versus early quarter last year. But come March, most of the companies had 15-20 days of impact of COVID. So you had low profit numbers in March 20, which would be different, hopefully, this year. And June was a washout. June 20 was a washout. So suddenly June 21 numbers for almost all the companies will look phenomenal this year. So I think next 9 months, we are heading to a scenario where earnings surprises are more likely than, earning disappointments. And I think that is something which we have to remember, because even if we know it, when the actual numbers come, there is always a impact based on those numbers. And I think a lot of this portfolio positioning is also focused on companies which were able to withstand during the worst time and which are set to grow faster when the tailwinds start to emerge.
Sunil, large part of corporate India was going because of 3 factors: inflation, rupee depreciation, and I hate to use the word, but there was crony capitalism which was also at play. Those 3 factors may be missing for next couple of years. However, impact of low commodity prices and low inflation is something and low oil prices is something which will now kick in. So which companies do you think are potentially out there to gain and grab more market share? Because the trajectory of earnings in terms of a tailwind or the scenario has changed from inflation, crony capitalism and rupee depreciation to lower interest rate, efficiency and productivity.
I think it's an excellent question. Nikunj, you have to remember one thing. What is market price? Market price is a function of earnings and PE. Earnings is the EPS and PE obviously is the perception. So companies making the same profit trade at different valuations. Some would trade at 5-7p, some would trade at 50-70p. And I think the same would be the case with overall India as well as the overall corporate earnings. So yes, earlier the earnings were because of inflation, because of rupee depreciation, because of so-called crony corporate capitalism, and therefore the PE which those earnings were getting were lower. Now the earnings are very efficient. We are in an environment where, it is a very competitive world. We are less bureaucratic, I'm saying hopefully. And we are also in a scenario where earnings are because of volume growth and not necessarily because of inflation. So the quality of earnings is better, and therefore the PE of the earnings which India should get should increase. The other thing is, we are in a phase where, as you rightly said, that interest costs have collapsed. But corporates are still borrowing at high interest cost because the banks have been very cautious about lending. Imagine a scenario where interest costs for corporates fall by 20-25%. And you'll have companies which will suddenly start to see their PBT much higher in terms of growth than their operating profit. In fact, we as investors always keep on pushing companies that reduce debt, become debt-free. I think it should be the reverse. This is a time where companies should be borrowing money and investing because, getting money so cheap. A 6-month CP for good companies is available at 4%. There was one PSU which announced a buyback saying that the cost of borrowing is so much lower compared to the earnings which they're getting. So if a PSU can think like that, I am very surprised why private sector companies are not thinking like that. So, it's a little bit revolutionary, but I would say that this is a time for companies to in fact borrow and spend on increasing their business rather than doing the other way around. I would say that the next 3-4 years, obviously, COVID-2 not becoming a pandemic again is a question mark, and I hope it doesn't. But we will in India have two big tailwinds. One is the interest cost. So interest cost going down aids profitability for corporates. It also leads to a very, very, big tailwind for consumption. Imagine if you are buying a apartment of 1 crore and you pay 30% upfront, so you have a 70 lakh loan. Earlier, you were having an EMI of 70,000-80,000 rupees, and now you are having an EMI of 50,000 rupees. It's a big swing. So that would aid that. And the second is power cost. India has the highest, the most expensive power in the world. And now with coal prices collapsing, gas prices collapsing, solar becoming more efficient, and hopefully with this focus on reducing the T&D losses and, theft, we are heading into a scenario where power cost should come off. I don't know whether people realize it, but residential power rates in Mumbai, for example, have been reduced by almost 25% since April. And if you see your bills, you'll realize that. So I think that is also going to be a big, big tailwind. And, again, as I said, it's a disclaimer, we have been optimistic, perennial optimists and perennial bulls. But frankly, that's paid off over the last 20-25 years, despite bouts of markets having its ups and downs. So things are hopefully moving in the right direction. I think all we need is a push from the government to encourage entrepreneurs, and we need them to be a tailwind rather than a headwind.
Bring this point for the benefit of our viewers out. There's an old saying on Wall Street that more money is lost when you are waiting for the correction or anticipating a correction rather than when the actual correction occurs. The beauty of long-term investing is that if you remain invested in the market for a longer period of time, if you let your money work, the chances of outperforming and chances of reaching your financial goals are much higher rather than taking a view on the Nifty and then taking a call on the stock and then timing it. A point which I am trying to bring out again and again, and we discussed this point with Sunil once again, but just, since this is a special show, Markets and More, I thought we'll try and also bring out some important aspects of market behavior and investor psychology. Sunil, you have divided your portfolio into 3 buckets, if my understanding is right. Cyclical opportunities, 1 to 1.5 year trade. Companies which are at an inflection point in terms of growth or market share, and then classic compounders. You are happy to buy these stocks for 5, 6, 7 years. Fill those buckets for our viewers.
So, Nikunj, I think you have put it rightly. See, India is a very interesting country. Unlike Brazil, which is more commodities, or China, which is more public sector, changing now, but it's still predominantly public sector, or Russia, which is more oil and gas. We are to some extent like America. We are a very entrepreneur-driven economy. We grow because of entrepreneurship, and that has been the driving force for our corporate growth as well as for our economic growth. And we have companies across sectors. So I think there is one bucket where, as you rightly said, there is consistency in terms of growth. There would be some consumption companies, IT I would classify in that bucket, maybe a few pharma companies predominantly on the domestic pharma side. Then there are new opportunities which are coming up, and new opportunities coming up from multiple factors. We have to remember that China is becoming the villain of the world. And across the board, there is a little bit of shift from importers to move away from China and have a second source. And India, though, might be a little bit behind in that race, but we still are getting benefit. And we are seeing that in chemicals, in textiles, which we had great results, and so many other things. And then you have new opportunities which come up, which are like new age businesses, which will just come and just explode. In between that, we have the domestic opportunities and the cyclical place where prices determine whether you're going to make money or not. And these are stocks and sectors where if you go right, for 1-2 years, you can have like 3-4x. So I think what we have done, you rightly said that, we have some, you can say, big alpha creators if we go right. I think we can go right, we can go wrong. So you can't be very big in them. But you know that if you go right, there is a big alpha to be created. And then there are stable companies where you know that these are companies which will not give you shocks. But even within that, we try to see whether we can get companies which can do slightly better than the market. And then you have those cyclical bets, which we keep on taking from time to time. And I think the good thing about having a diversified portfolio is that it adds consistency, it adds alpha, and it also adds a little bit of differentiating return if you go right. And I think that is something which I would urge every investor to do. One other interesting point which I would like to highlight here, Nikunj, is that we have been in a scenario where US dollar has been appreciating last 10 years. Just before the elections, dollar started to depreciate. But when the risk averseness started before a week before the election, the dollar appreciated again. I think once these election results are out of the way, the dollar looks like depreciating again. And that is going to lead to at least a near-term move up in hard commodities, and also emerging markets. And I think there is a possibility of a big carry trade emerging because, interest rates in US or Europe are so low. There's so much liquidity. It makes sense to borrow there and invest in some high-risk assets, of which emerging markets in India would be a key component. And all said and done, for India to grow at 7.5-8%, we have to have at least $50-100 billion of FDI/FI flows coming in every year. And that can be another big trigger. The good thing is some large companies have been able to attract huge investments, which is good for the company, of course, but it also is good for the economy in general, because that has led to, our currency being quite stable, as also liquidity being available to withstand the pandemic, which otherwise India would have found it very, very difficult to face.
Right. All right, Sunil, fantastic to have you back. And thank you for joining us. That was Markets and More with Sunil Singhania on what really lies ahead, why markets have made a comeback. In case you are wondering, in case you are still gazing at the markets, well, remember, markets and economy, they're two different things. Economy may come back with a lag effect, but markets, they tend to always outperform. And today's summary is that stay invested, the best of India is yet to come.